Thanks, Roberto. Thanks, Chris. Yep, another Chris here, Chris Sampson, one of the founders at Fathom. I'd just like to say that to my shame, this is my first GFP meeting, and it's been a real pleasure to meet so many new people working in this space. So thanks to the organizers for inviting me along, and hopefully you'll allow me to come back. A little bit about Fathom. Fathom is a flood modeling company based in the UK. We were founded about 10 years ago out of the hydrology research group at Bristol University. Now that group had been working for about 10 years on the development of very efficient shallow water models, so two-dimensional flood models, and the application of those models to remotely sensed data, the kinds of data that were being collected routinely for the first time around the turn of the millennium, so things like LiDAR. And the idea of the business was to take those technologies and methods and scale them up to the global scale, and then get them into the hands of as many users as possible. And that continues to be our aim today, is to build the best global scale flood maps and flood models that we can. We've got about 60 people now working within the business. And academic research has always been really important to what we do. So we've sort of built the business around that idea of transparency and publishing the work that we do and our methods so people can understand what underlies our products and our data. And that's something that we continue to do. Now, this talk is going to take, I think, a slightly different angle to the others that we've had so far, because I'm going to look at the private sector and try to explain why I think, anyway, the adoption of global flood risk data and global models has increased so much in the private sector over the last few years, because there really has been a big increase. If we go back to 2010 or so, when I was starting to get involved in this space, and we looked at large scale models, so national scale models, the private sector was barely using them at all. There was a little bit of modeling within the insurance market. Those models were limited to a few countries, UK, Germany, parts of America, maybe parts of Japan, and that was about it. And even those models that did exist within the insurance market were limited to big rivers. There was no surface water modeling. They weren't limited to small channels. So it was a very, very limited kind of uptake in the commercial sector. I'm not obviously talking about engineering models. They've been widely used for decades, but national scale models. And if we want to look at one of the main catalysts, or what I think one of the main catalysts for a sudden change and increase in interest in global scale modeling, it was this event, Thailand, in 2011. Now this caught the insurance industry in particular. They did not realize the degree of exposure that they had. And these floods impacted Bangkok very severely. They caused something like $50 billion worth of economic loss. They caused nearly $20 billion worth of insured loss. And what was interesting is that loss was very concentrated into a few industrial estates to the north of Bangkok. And it had pretty profound impact actually around the world, because things like most of Western Digital's hard drive stock for the planet were in these warehouses. So the price of hard drives doubled. And there were sort of knock-on impacts through supply chains, and it kind of woke the industry up to the fact that there was a whole bunch of risks they didn't know about, and there was suddenly an increase in demand for models in territories that hadn't previously been modeled. And so as a group at Bristol, we basically looked at the problem of trying to build models globally and figured that these 5 areas were the areas that really didn't work if we were going to try and tackle this problem. And I think it is improvements in all of these areas over the last decade or so that has led to the models being so much more useful, and as a result, use case increasing and the uptake increasing. And if I was going to point to one component that I think has made the biggest difference to us as a community, it's the terrain data. So in 2010, we were entirely reliant at the global scale on the terrain data derived from the shuttle mission, so SRTN. And that data, although very, very useful, had a real limit to what you could do with it because the noise was so small. The release of Tandem X data and the ability now to use it commercially has made a huge difference. The burst precision has increased enormously. it's had knock-on effects through the rest of the modeling. It means we can much better define river networks. That then means we can better estimate our river channel parameters at the global scale, and model performance has just improved as a result. I mean, we've heard about the others as well, and Bastian gave a really interesting talk on kind of new, really efficient methods to look at the hydraulics or to emulate the hydraulics. So there's progress everywhere. I mean, if I look at the code that our developers can now do on the automation side of things, the kind of Python workflows that now exist compared to the clunky MATLAB stuff that I made 15 years ago. It's pretty remarkable how this is all progressing. But when it comes together, I mean, it's making really significant differences. And I know we all love some qualitative validation here in this room, so I'll give you some pictures. This little image here just shows the progression of our modeling framework over a Catherine Zimbabwe. The top panel is the first version of the model, the middle and second, and third is where we are currently. So that top version is running on SRTM. You can see we're only really able to capture the big rivers. You can see pretty significant discontinuities in the smaller river channels. We've got these breaks in the river network. Everything looks kind of blotchy, which is a signature of SRTM data. The middle panel is where we managed to get to with the best that we ever really did with SRTM, which is using merit debt, which is Diane Yamazaki's pretty seminal piece of work. You can see we're capturing the smaller channels a little better. We're starting to do surface water modeling, although that's still very spread. It's the smoothing that we had to do over SRTM to make it useful. And then in the bottom panel, you know, we're now onto the tag X-based data with all the other improvements that have come along. We've got, you can start to pick out features within the floodplain itself. You can see that the surface water modeling and small catchments are better constrained. We haven't got discontinuities in the river network. And so that's all nice, some pretty pictures. I apologize to Guy for putting some more academic kind of things on the board now, but to try and use something and show you a bit more quantitatively what's happening, and to hopefully give a bit of credibility to my claim that these models are getting better. This is speed and validation metrics for the current version of our models, so that's GFM3, then GFM3 versus 2, compared to the entire US FEMA catalogue. A really nice Iowa flood center catalogue. Recommend you look at that if you want some validation data for large areas. UK Environment Agency. These are model comparisons, obviously with all the catalysts that entails. But you can see that the critical success index is moving forward and improving across the board. Kind of regardless of which return period you look at. If we want to compare against some observed events, for example, again, you can see improvements in the CSI scores, whether we're in Oman, Mozambique, or in the UK. I think also, if you look at the bottom right there, that's comparing water levels rather than binary fit patterns. So actually looking at the water heights coming out of the model, and we can see a really significant decrease in error. And again, that's primarily down to the improvement in the DEM, I think, and the better river network definition that we can do as a result. Just graphically, if you prefer, top left is the CSI circles, the new models. X is the old model. Circles are higher, that's good. Top right is the top left. Top right is the absolute error in elevations. New models substantially lower, consistently lower. And then the bottom panel is the error profile itself. And you can see that error characteristic is looking a lot more Gaussian now, and it's clustering closer to zero. It's a little bit negatively biased still, which is interesting, but still definitely an improvement, I think, over where we were before. So hopefully that gives you some comfort around my claim that the models are getting better. It's just because it underpins, I think, the key point as to why people are starting to use these models more broadly. And that is that we are now able, for some use cases anyway, to use global models at the location level rather than just at aggregate levels. So the first version of our data, you simply couldn't use for any kind of location level analysis. And I think that was true for all global large-scale models that were being produced 10 years ago. You could use them to look at broad areas. You could use them to do aggregate risk analysis, reinsurers potentially using the portfolio analysis where the areas of individual locations cancel out, but you couldn't do anything with individual locations with it. The models just were not accurate enough. We are now seeing our clients using these data at the location level. So this isn't just us saying that you can do it. In fact, we're very careful about saying people can do things at the location level with the data, but they are choosing to do things at location data. So some examples are insurers now using the data within automated underwriting processes. So drawing on the data to automatically calculate premiums for individual policies at individual locations. We're seeing engineers using the data during project screening phases. So you still couldn't use the data and shouldn't use the data to plan any kind of interventions. You can't use these data to say flood defense location needs to be 2 meters high. They're not accurate enough for that. But everybody is cost constrained, and what you can use these data to do is prioritize where you want to send your team to build your headcount to spend that local money. And we're seeing engineers increasingly using it for this all over the world, which is pretty interesting. And then government agencies as well are using the data as base layers. So lots of governments will have local studies, but they won't have a comprehensive coverage of flood risk information for the whole territory. And so they'll use this data as a base layer, and then they'll supplement it with the local data that they do have on top. So we've been doing that in places, particularly in the US at the state level, Texas, Virginia, Florida, for example. And you can do things that look a little bit like this. So this is an example from the US. On the left is the FEMA 100-year zone. On the right is our data sort of picking up from that. And you can see the difference in coverage. The large rivers look similar, but you extend well beyond where FEMA have modeled. This has some really interesting implications in terms of exposure. You can see we're suggesting that there are almost 3 times as many people exposed as FEMA are, if we look at the country as a whole. And this is a number that does actually seem to bear out in some observed events. If we look at Hurricane Harvey, for example, over Houston, about 2/3 of the people whose properties were flooded during that event were outside of the FEMA zones. That's not because the FEMA zones were incorrect where they existed, it's just that the model coverage was limited by the nature of the models that existed. So it's you know, there are quite a few use cases now that are springing up that are driving adoption. However, it's not only improvement in models that have increased adoption within the private sector. There's also new demand that we're responding to, and one of the biggest areas of demand is around climate risk analysis. Now, I don't think anybody in this room will probably argue with me if I say that climate models and risk models are very different things. We're at 2 opposing ends of the risk scale. Climate models are very good at kind of continental scale, long-term averages. In the risk community, we're interested in short-term extremes. So these are very different things. But these modeling frameworks, the flood modeling frameworks themselves, are very useful tools because you have a very consistent model structure over a very large area. So if you kind of poke those models, if you perturb the boundary conditions of those models, you can see which areas of the ground are likely to be the most sensitive to any changes that do occur within the hydrological regime. So the classic way of doing this and the way that we do it is to look at change factors that derive from climate model ensembles. I don't think anybody believes the absolute numbers that come from those change factors. You've got a change factor of 27% for 2050 under a given scenario. I don't think anybody believes that we really think it will be exactly 27%. But what it can do is give us an indication of the direction of change. We can apply those to the model boundary conditions and we can see on the ground which areas are going to be the most sensitive. And that information is actually really valuable now to asset holders who are looking at long-term time horizons. So people who are building portfolios, holding portfolios of assets, people who are investing, states who are investing, want to see whether or not they are likely to be exposed to any changes that do happen, or whether, kind of regardless of what the climate signal is, they're pretty safe. I also, just on this point, want to pick up something I think it was mentioned by Marco on Wednesday, which is that in the climate change impact space, there's always focus on the hazard and the changing hazard, but actually it is just as much, if not more, the case that changes in vulnerability and changes in exposure and urbanization are going to drive an overall change in the risk. We've done some work in the US with the EPA looking at their changing urbanization projections. And that has shown that actually just future urbanization, where the urbanization is going to occur, drives something like 3 times the change in risk that the climate signal does. So I do actually think that as we look to the future, yeah, it's the exposure side of things that is probably more important than the climate signal. And yeah, so I mean, we have climate conditioned the latest version of our data, so you can pull maps for any climate scenario out to 2100 that's within a 5-degree warming signal anywhere on the planet. And you get some, I don't know if, yeah, it's probably, you can see this, you get some quite interesting patterns. Flood risk isn't going to increase everywhere, as a lot of people who don't work in this space automatically seem to assume that climate change means everything gets worse everywhere. Not the case. The signal is definitely more complicated than that. Surface water flooding looks more consistent and looks as though things are going to get worse in most places. And actually, we've done some work in the UK Met Office using very high resolution, so sort of sub 1 kilometre scale regional models that better resolve the convective processes. And they seem to show a stronger signal in terms of surface water risk getting worse. The fluvial signal is much more complicated because of the complicated dynamics of potentially drying catchments. And the risk at the coast is pretty consistently getting worse, which is unsurprising because sea level rise is baked in and well understood. And all of the extremes to do with hurricanes and surges are superimposed on top of a baseline sea level. So we do expect that to continue to get worse. The other thing that's changing is cat models and the march of cat models out of the insurance industry and into the wider financial market. So cat models are tools that are used by insurers to try and price risks. They're fairly complicated things. They look at simulations of thousands of years of events. So you've got thousands of flood footprints, hundreds of thousands of flood footprints that you then intersect with your exposures, things that you own that are in your portfolio. You then calculate the vulnerability, so the damage to every asset of that given event, and then you use the financial model to apply financial terms to your insurance policy, deductibles, limits to actually calculate the loss. And the key thing is that you're doing this across your entire portfolio, so you can understand how the assets that you hold are correlated and whether everything that you own in a certain area is going to get impacted by the same event. And what we are seeing is that it's no longer just the insurers who are interested in this model. It's spreading into the banks, it's spreading into the big consultancies, because whether you're a state wants you to know whether multiple hospitals are going to be impacted and multiple response sites are going to be impacted by the same event, or whether you're a manufacturer and you've got lots of factories and you're worried about supply chain risk, or whether you are a pension scheme that has lots of real estate investment. All of these guys are realizing now you have to look at risk from an event basis and look at correlations. And this is driving an increased demand for this kind of data and model. We're also seeing a lot of movement of cat modelers from the insurance market into the wider financial sector, which is indicative of what's happening and the spread of knowledge and therefore the spread of demand for these kinds of data to the wider market. Kind of what the loss curves might look like for entire countries, for example. And we're about to launch a global cat model, which enables you to calculate these kind of losses anywhere on the planet and understand correlations over very large areas. I think the final thing is that the data is getting a lot easier to get at. So, you know, these academic data sets that we produce, they can be incredibly impenetrable and difficult to get at. Terabytes of data in pretty impenetrable archives that if you're not in this world, they're a real pain in the ass to work with. And what we're finding is that lots of organizations are working on variations of this theme, which is web viewers and APIs, to make the data far more accessible than it used to be. We've had a tie-up recently with Swiss Re, which means our data is within their CatNet platform, but it seems to be that everybody's doing it, whether it's the Moody's RMS team, MSCI, whether it's the big consultancies. We're seeing lots of people building platforms that look like this, the aim being to make the data more accessible to more people, both in the private sector and not. And so this is kind of an example of where we are today as a company. I'm sure that Deltaris and HKV will have slides that look similar to this, maybe with slightly different weightings in different sectors. But these are all people who are now paying to use the kinds of data that we in this room produce and work with. So you've got insurance companies in the left-hand column, you've got financial houses, consultants, banks in the second column, you've got the global engineering consultancies in the third column, you've got people like the World Bank, blue chips, and other organizations in the fourth column. So a real diversity of organizations that are using the data. And I mean, if anyone's tried to get money out of any organization for almost anything, you'll know how hard it is to do. So the fact that people are prepared to pay, in some cases, quite significant amounts of money on a recurring basis to use this data, I think really does give evidence that they're using it, because if they weren't using it, they wouldn't be paying for it. And so we are seeing it move through the industry. And I mean, I hope that that's a little bit encouraging to people who are working in this field, to young researchers in this field, to see that the data and the models and the techniques are moving out from academia into the wider world, because many of these organizations, they do wield quite a lot of influence. The big banks, big rating agencies, the big engineers. And I think it has to be a good thing that these kinds of data are finding their way into their day-to-day operations, into their decision-making, into their financial planning. Clearly, there's a lot more to do, and the models are getting better all the time. And as that happens, the use cases grow, and we see more and more adoption. So yeah, I think that's me. I'm out of time.
Thank you, Chris. Again, we have maybe time for one or two questions.
I dare to ask this. You actually ended by opening this up. So I think a lot of people in this room and elsewhere know what you guys do, know what others do in the commercial sector. It's great. It's really fantastic. And I also know you work a lot on research, research development projects with people who publish in open journals. I saw a post yesterday, RMS announcing, and I think you partner to give it a go and try open access, open data. What does that mean if could your data, with some form of your data, actually really become open of some form, or is it more open to the insurance sector rather than everywhere? So could we actually think of being able to work with your data, having this group of others?
Yes, I mean, so there are various flavors of open data. We're having a discussion at the moment. So if you're a commercial organization, you're not reliant on government funding, so you have to be able to generate revenue from the data that you produce. And some organizations, like Deltaris, like HKV, for example, will generally work on the principle of providing consultancy services to fund, and they may make more of the data or models open source because they're working through a kind of consultancy business model. We don't do that. We try to put our effort into improving the models. You have a limited amount of staff time. You're doing loads of consultancy. You've got less time to develop the models and the methods. We currently do openly share the data with academics. So if you're doing academic research, you can have an academic free of charge license to the data and use it. And loads of groups around the world do, which is why we have not only publications that we lead, but a massive body of publications from other people using our data. We are considering, and I can't make any promises on this, but we are considering fully open sourcing under an unrestricted license, or possibly a non-commercial license, Africa. So our data sets across all of Africa. It's something that we would like to do. And I think it's something that we could justify because the majority of our revenue comes from the developed world rather than the developing world. And opening the data over such a large territory would enable more collaboration, would enable more governmental use and more adoption of the data. So I think there is a general shift towards open sourcing of both methods and data. I don't think that direction of travel is going to change, but you just have to be careful as an organization that you don't completely undermine your ability to actually continue to exist. And so that's the balance that we're always trying to strike.
So Chris,
Yeah, I suppose really must work on a cloud. So, just a quick question. On one of the slides, you show CSI was consistently improving as the return period increases. Yeah.
Previous one, probably, hang on, that one.
That's it. Yeah. So I was wondering what explains that, and do you not want your model to be a lot more accurate and more frequently occurring events?
Yes.
Which is the lower return periods. So how do you reconcile that?
Okay, so a few questions there. Yes, performance scores consistently improve as the funds get bigger. Yes, we would like the models to be more accurate for high frequency floods. They are much harder to simulate. Once you get to a point that a floodplain is full, it's pretty easy, right? You dump a load of water into a model, and once that floodplain is full and you've kind of reached the point where the topography really starts to change. I mean, Bastian and I had a play with this yesterday. You double the amount of water in the floodplain and it barely changes the flood footprint. What that means is that the sensitivity of the model and model performance at high return periods is much lower. When you're just crossing that threshold of where the river channels go out of bank, you get a really big change in flood extent for a relatively small change in water level or discharge. Because floodplains are relatively flat, right? So you don't have to increase the water level very much to get quite a big change in extent. And it means that it's much more difficult to get high performance at that point in the frequency curve. The models are incredibly sensitive to small changes. It also means that any errors in your channel geometries and your estimates of what the bed elevations look like, the bed gradients look like, can make quite big differences to model performance. So that's what drives it, and you'll find it's the case with any kind of validation that you do. We've never found a situation in which it's easier to get high performance for high frequency floods than for low frequency floods.
thank you, Chris. Well, I mean, can I comment on just one thing, because it was it is a very interesting thing, yeah, I mean, some models are very good, as you say. I mean, as long as we are accounting for really big extremes, but variability becomes problematic, I would say, for high frequency ones. There is a lot of help to come, from let's say systematic, I would say, use of satellite data. We've started doing something, together with JPA, in some places. Maybe I can show you how it works. But for example, constant use of satellite data to be correct. Well, very good for underestimation of models, a bit more tricky, for, let's say, overestimations. But you could do a lot, in correcting the frequencies and the extension with the satellite data. It's a hell of a work. So I don't know, commercially speaking.
Well, so I'd just like to add to that. Satellite records are relatively short but growing.
Yeah.
The place that the short record is most useful is for a high frequency event. We can't use satellite data to really understand the 100-year floods or the 1,000-year floodplain for very obvious reasons, right? But we can start to use them to look at 2-year bank, like what's the bank fuel discharge, what's the 5-year. SWAT, no one really yet at this session has really talked about the SWAT mission that's coming along. That's incredible. The data that's coming out of that, the early data that's coming out of SWAT is unbelievable. We're able to resolve far smaller channels than we thought we were going to be able to. Sorry, that's the Surface Water Ocean Topography mission. It's the mission that is measuring the water level from satellite every few days, everywhere on the planet. The mission spec was 90 meters, 90 meters, I think. And it's actually managed to resolve channels down at 15, 20 meters pretty consistently. What that's going to mean is that we've got accurate water elevation profiles all over the planet about once a week on pretty small rivers all the way through to the biggest rivers in the world. Using that information then to better define what the river networks look like. We've got good water surface profiles we can use to back out the bed elevations. It's going to make a profound difference to how accurate models are at high frequencies.
Thank you, Chris. Thank you for these insights.